Hello and welcome to another episode of Phillip Research in 3 minutes. This is Natalie, REIT and Property Analyst with Phillip Securities Research. Today I'll be talking about our recent upgrade on the REIT sector and the COVID-19 impact on S REITs. We upgraded the REIT sector to overweight on the 9th of April on attractive valuations when 4 out of 6 subsectors were trading at below average price to net asset valuations, NAVs for short. While the healthcare and industrial subsectors were trading close to average price to NAVs, at 0.45 times and 0.66 times price to NAV, the hospitality and retail sectors were 50% and 30% below average price to NAVs. Sector dividend yield was 6.2%, and this was 35% higher than the average yield spreads of 4.6% last year. We found dividend yield spreads attractive at 5.2%, which was at a positive 2.6 standard deviation level, twice the average yield spreads of 2.6% seen last year. Since then, prices have rebounded sharply. Current yield spreads at 4.1% is at a positive 0.8 standard deviation level. Hospitality and retail REITs were the most affected by the containment and stabilization measures implemented by the government. The COVID-19 bill will grant rental deferment of 6 months to tenants who have been materially impaired by COVID-19 and are unable to pay rent. However, this will lead to cash flow mismatch and bad debt risk for REITs. To address REITs' concern of mismatch in cash flows, the Ministry of Finance and IRAS have extended the timeline for REITs to distribute at least 90% of earnings from 3 to 12 months, while the raising of leverage limits from 45% to 50% by MAS and SGX Redco's enhanced share issue limit will allow S-REITs flexibility to manage their capital structure. Higher leverage limits will also give REITs buffer should asset valuations start to deteriorate. The increased leverage limits will provide for revaluation downside as well as allow room for bad debt provisioning. Among the subsectors, we expect suburban malls as household catchments to perform better than their central peers and service residences to outperform hotels owing to their longer-staying corporate clientele. We may see some right-sizing within the commercial sector as the successful implementation of remote working has accelerated the technology-enabled structural shift in demand for office space. Probably the only beneficiaries, COVID-19 has reiterated e-commerce and cloud storage trends of the future, and we will likely see more demand for these industrial asset classes. Once shoots of recovery appear, REITs will start to notice the attractive acquisition conditions, the higher leverage limits, and the enhanced share issue limits present, especially in this low interest rate environment. The COVID-19 outbreak may be the re-rating catalyst that helps S-REITs overcome their prudence and tap into their gearing headrooms for acquisitions, which may lead to a strong recovery for the S-REIT sector. For the full report, please visit our website, stocksbnb.com. Thank you for joining us and tell us what you think in the comments below.